Okay, let's roll. Hi, everybody. Thanks for joining us here again for another Twitter Spaces version of JMB Go Get Alive. I am Carrie Ann Stimson. By day, I am JMMB's Group Chief Marketing Officer, and by other hours, I do everything else that life brings my way. But as usual, I'm always happy to host these sessions on behalf of JMMB, and we have another interesting discussion. We had a great discussion a couple weeks ago where we were looking at investment opportunities for 2022. And as always, what we like to do is we like to reach out to people and say, hey, what are some of the topics that you want us to discuss? And managing debt is a big one, right? Now, I like to keep it all the way real, which is what JMMB is always about, all the way real, breaking it all the way down. So let's just start and say this: debt is not a bad thing in and of itself. It's not a bad thing. I have some debt personally. I think almost everybody on this live has debt. So the thing is, we're not going to argue to say, well, nobody should be in any kind of debt at all, right? It is what it is. What we're really going to discuss is what's the kind of debt that is termed to be good debt, or debt that's going to help us to progress and achieve our goals. And then there's other kinds of debt that we should be either trying to avoid or minimize as much as possible. And of course, we're also going to be touching on what and how can we use debt to achieve whatever it is we've set for ourselves financially and wealth creation wise. So it's going to be an interesting discussion. If you know anybody who wants to join in or you think could benefit from the conversation, tell them to come on over. We'll be here until 8 o'clock. Where we're just going to have a conversation with two of our awesome JMMB team members, both on the JMMB bank side and from the JMMB investment side. They come to us from. Right. So first and foremost, we have the lady Monique. Monique, that's my middle name, by the way, coincidentally. So I know already you are an awesome person. So Monique is a retail banking officer with JMMB Bank. And then Monique, I think this is your first JMMB Goal Getter Live of any sort, right?
Yes, it is.
Right. There we go. Perfect. So thanks for joining. I know you're going to have a lot of fun. Thanks so much for participating, especially on what could be construed as tight notice. Thanks for being a part of this. And then Andrew, or who we love to call Jojo, is no stranger to Goal Getter Live. We've an Elevate. I mean, marketing, JMB marketing calls on Jojo quite often to come and share his expertise with us. Andrew is the team lead with JMB Investments at our Portmore location. So Andrew is on the investment side, Monique is on the bank side. Hey, Jojo, welcome. Thanks for joining.
Hey, Carrie, happy to be here and good night to everyone.
All right, awesome. So great. Thanks again. So you guys, you can just keep muted until it's time for you to speak. And then what I'll do is I'll just bounce the questions back and forth. And then if time permits towards the end of the discussion, because we really want to make sure that we cover everything we had set out to cover. But if time permits and we're able to take questions, then we will. But also to note, guys, that this session is being recorded, so no worries. We're going to be recording this, so if you can't catch it all, or if you joined a little, or for those joining late, they will be able to catch the recording, and certainly be able to share it again with anybody else who you think could find this information valuable and couldn't get a chance to join us live. So let's jump right into it. Debt. So I've already said it. Debt in and of itself, as a word, as a thing, is not a bad thing. Probably everybody on this live has some kind of debt in some way, shape, or form. So let's just start off, Monique, since you are the banking lady. Um, Tell us, is there such a thing as good debt? I think I kind of touched on it earlier. Good debt versus what is called bad debt. We know there's the accounting phrase bad debt, which is usually when a debt goes bad and the person is unable to pay, and the creditor, the person who lent the money, have to write it off and all of that. But this is not an accounts class. But so from the individual's perspective now, person who goes into debt, is there such a thing as good debt versus bad debt? And could you explain what that is exactly, please?
Sure. Good night, all. All right. So I'll just start with just a little tidbit of what debt management is. So it speaks to the process of managing or maintaining your debt at a comfortable level. It can also refer to the process of getting your debt under control if it is that the situation becomes concerning. This is usually done through budgeting and financial planning, and the aim is really to lower and ultimately eliminate your debt. So, good debt versus bad debt. This is one of those gray area topics. It's not something that you will readily say yes or no. Boring, sorry. Just the word debt sounds like a bad thing to everyone. So I'm glad that Kerry kind of jumped into it to say that, debt can be useful. So we can make that distinction between good debt and bad debt. The term good debt usually refers to those debt that have potential to increase your net worth or to improve your life in an important way. So, for example, purchasing a home, furthering your education or your child's education, or even investing in your business can be considered good debt. Bad debts are those that lessen your net worth or does not provide any return on your investment or income. So taking out the loans to purchase furniture, for example, can be classified as one of those bad debts. And these are usually at higher interest rates. And then we have other debts that we can't really put in the category of good or bad debt until we see what the results are. So sometimes persons may borrow to invest, for example, and we can't say it's a bad debt or a good debt until we see what the investment is yielding.
Okay, great. Thank you so much for that, Monique. So I think that's a good way to start off. So basically, if you're taking out debt for something that could be construed as you're acquiring a value, an asset that appreciates in value, right? Some could argue maybe like a home or investment property, preferably, then that's pretty good debt. But if we're taking out debt to acquire a piece of furniture, over time the furniture go fall apart, chichi go eat it out, etc., etc., that's what you could probably construe as bad debt. And because it's really not an asset that's going to be appreciating in value or growing your wealth in any way, certainly depreciates over time, certainly in the case of furniture. And so the reality is that what I'm picking up is that it's not so much that, well, if you need to get a loan to get a bed to sleep on, you got to do what you got to do, but the goal is to minimize the amount of quote unquote bad debt that you have holding versus, I guess, any other kind of debt. Am I picking that up correctly?
Exactly, Carrie.
Okay, great. Thank you. And you ended with a point. I'm going to jump over to Jojo now because you ended at Andrew. I'm going to stop calling you Jojo because it's your Twitter handle that has me calling you Jojo. Oh my
Carrie,
gosh.
either name works, man. Either name works.
I know. Thank you so much. Me never want to have it said out the resume. So my apologies. And I didn't want Mrs. O'Connor to call me. I'm kidding. She knows she's cool. But yeah, so Monique ended on an interesting point just now because she spoke about something that people use debt to do, which is people use debt to leverage what we call a goal achievement, right? So there are some people who use debt to actually grow their wealth in a real way. And we know we've seen this in JMB investments in particular. Andrew, could you kind of just expound on that and tell us how people do that in terms of leveraging debt to make more money and achieve overall financial goals, build wealth specifically?
All right, yeah, Carrie. So let's just quickly define what leveraging is, or for the sake of this conversation, let's just explain what we mean by leveraging. And leveraging is just simply using borrowed capital or using something to maximize or to make maximum use of an advantage that you have. So you may have an existing investment. Let's say you bought some stocks or you bought a bond or you have some funds on a fixed deposit. You can now use that as security for a loan. So, let's use companies, for example. Companies come to the market all the while and they borrow money from investors, the average Joe on the road, and they use that money to expand their business. So why is it that us as individuals, why can't we use that same business model to, advance our own individual goals? So it's important for us to understand that, as Monique mentioned, there's good debt and there's bad debt, but we can use our investments or assets that we have. And by assets, it doesn't necessarily mean money in an investment house or money in a bank. It could be your house, it could be a car. You can now use that to to use as security to get funds to take advantage of an opportunity. So there may be an investment opportunity that is coming up, and I may not have liquid cash, but I have an asset. I can then use that asset to leverage. I can take the equity from that asset and pull funds from that to put in that investment. So therefore, I'm able to take advantage of that investment opportunity without even using my own cash, because I may not be liquid at this point. Now, we always talk about, goal planning and ensuring that we have liquidity, but let's just be real, and we're being real on this. There are times when we're just not as liquid as we'd want to be, but we may have an asset that we can use to take advantage of that opportunity. So it's very important that we look at those situations and judge them accordingly. One of the most important things to make note of, though, Kerry, is just to ensure that when we are leveraging an asset, we have to ensure that the returns that we're going to get from the investment opportunity is greater than the loan that we're going to take. So let me just break it down into terms. So let's say I want to an opportunity comes up for me to buy something and sell it back, and I can make 10%. That sounds good. But if I'm going to be borrowing money to take advantage of that opportunity and I'm borrowing at 12 or 13%, then it doesn't make sense, because I'm going to be paying more for the cost of the funds than it is that I'm going to be getting back from that investment opportunity. So while we understand that leveraging is a very good thing and it can be used effectively, we have to always do the dollars and cents of everything. So ensure that if you're going to leverage an asset to take advantage of an investment opportunity, ensure that the returns on the investment outweighs the cost that we're going to be borrowing the funds for.
Yeah, very, very important point. Because as you were talking, I'm thinking, I know that obviously just a way of probably could be a popular example. Lots of IPOs, APOs, and all these things going on. People would probably be tempted to want to take out loans, maybe secured loans against an asset, such as they may want to take out a cash secured loan. I know some people take out loan against them house and all these sorts of things, and so on, and use that debt to buy shares in an IPO or just buy shares generally, because they see an investment opportunity, they want to take advantage of it. But as you say, there is that kind of a cost benefit analysis that you have to do, because that loan not going away and the interest rate on that loan is probably at fixed, certainly at a minimum level. And you're going to now take that and buy into what could be a risky investment, such as stocks. That could probably juke you. I mean, what's your view on that, Andrew? I mean, what are the kind of conversations you have with your clients to say, well, how do they determine when it's prudent to do that? Take out a loan to invest in something else that could carry more risk and probably put the loan at risk as well.
Kerry, that takes us down a whole nother road. So I think you kind of answered it for me in layman's terms, but when you're looking to take a loan and you're going to buy something as risky as stocks, no, we have to understand that has no guaranteed or fixed return. So you're actually hedging your bet that your return on the stock is going to be greater than the cost of the loan. Now, in an instance like that, you have to ensure that if it is that the stock doesn't give you any return or even a negative return, that you are still able to carry or service that loan. If it is that you're able to do that, even if you get a zero return or negative return, then that may be a risk you want to take. Now, for the person or the investor who, if this investment doesn't give them any return or doesn't give them their required return, they're going to have problem servicing the debt, then leave it alone. It might be a good opportunity, but it's not a good opportunity for you. So, that is a conversation that we have with clients on a daily basis, because they may know somebody who did it and it worked for them, but that person's financial situation may be different from theirs, So we always try to push with clients that, hey, what is good for Joe is not necessarily good for you. So our conversations with our clients are usually very individual. We try to ensure that what they want to achieve, it is specific to them, and not that they're just trying to follow the herd or follow the crowd. So we always want to make sure that, hey, this is the situation. How does it affect you, and how can you manage it going forward?
Very important conversation, and thanks for raising it, Andrew. Great. So yeah, definitely something that people will have to be very cognizant of. Everybody say it may be a good opportunity, it wouldn't be a good opportunity for you if it is you're going to be taking out a loan to invest in something that could be quite risky. You lose money off of it, but yet the loan is still very much there to be serviced. Speaking of servicing loans now, Monique, gonna jump back over to you. This whole thing of credit score and credit rating, as we talk about servicing debt, could you start out by just, because I'm gonna ask a specific question, but what exactly in the Jamaican context is your credit score, so to speak, or credit rating? I know some people use the terms interchangeably, but what is that exactly in the Jamaican context? How is it generated, and how do I even know what mine is if I can?
All right, great query. So your credit score, it's generated from one of two bureaus. What they use is they pull the information from your TRN. So your TRN would have what your income is, because you know you're paying taxes, etc., and other information like work information. It also will highlight, it's one of those, it's the most unique or the easily identifiable number that we use in Jamaica when it comes to tracking monetary transactions. So you realize you're purchasing a property, your TRN is noted. Whenever you're filling out loan applications, your TRN is noted. So it pulls the information from the various systems. So the banks and financial institutions in general, they are required to produce this information to the bureaus at the end of the month. Not every single institution is providing that information now. Know that they're in the process of changing that to have every institution reporting those figures. Additionally, they have added your water bill to your credit report, so that comes as a part of how your score is calculated. So it looks at if you're missing payments, if your payments are being made on time, in full, etc. It also looks at what your income is and the total debt you have in comparison to your income. So unlike the US system where, you know, the more debts you have and you're paying them properly, you have a higher score. In Jamaica, it's the opposite. The more debt you have, if it is that your salary that is noted on the system can't carry it, or it seems too much of a percentage of your salary, then it impacts your score and you get a lower score. You can get your credit report. You can either approach a financial institution to pull that report for you. It comes at a cost, generally. At JMMB, to pull one credit report, it's $2,200 when we're doing loans. And additionally, though, you can get a free report from either the bureaus. Not sure what their system is like now, if you can go in the offices, but I know you can definitely get it online. So the free report does not come with a score. It will show you what your debts are and how you've been paying them. The one that comes with the score is the one that you would pull from a financial, that would be pulled by a financial institution.
Do you know the names of those bureaus offhand, Monique? I don't know if I'm putting you on the spot, but I don't know the names of them.
So
If we're to
kind of on
reach
the
out to
spot,
them.
because I do know
No problem.
No, I can answer though. So CRIF, I know that's not it's an acronym. So there is really, you know, the word that goes with it.
CRIS. CRIS.
CRIF, as in frog. But
Oh,
you
okay,
also have
frog.
Credit Info. So those are the two bureaus in Jamaica.
Okay. And you can reach out to them. They could generate a report. I'm not quite sure what the procedure is, so folks would have to contact them directly to get the procedure. And if there are any associated costs.
It can be requested online. You're entitled to one free print per year.
Oh, great. From each of the bureaus.
Yes.
And then, of course, if you want it from your financial institution, usually as part of maybe a loan application process is when people would tend to want that, then you would pay whatever fees your financial institution charges to generate that. And it would be through your financial institution actually getting the score. The bureau is
Yeah.
not giving you a score per se. They're just kind of giving you what the landscape looks like in terms of your debt. And you're saying it's picking up quite a bit of things. It's picking up the JPS bill to Monique.
Not JPS just yet. I have not
Wow.
pulled any, but I've pulled in recent time and I've seen the water bills on it. So I
Okay.
know there's also the slot for telecommunication. So, your flow, your digital, those are things that we could look for in the
Wow.
future being reported on it. So not paying those bills will definitely have an impact on your credit score in the future once they are added.
Okay. Interesting. Well, if JPS gets added, that's a whole new dimension. And guys, I'm just going to declare I'm not a financial advisor. I work at JMB. So I'm learning from these sessions too. So pause. Thanks again, everybody, for joining. We're going to be here until 8 o'clock. I'm chatting with Andrew and Monique about how to manage debt, all the various things you want to know. This session is being recorded. So if you missed whatever we started with earlier, you can catch a recording when we post it, or you can certainly share it with anyone who you think would find it interesting. So we started out, we spoke about what's the difference between good debt versus bad debt. We touched on how we could perhaps consider leveraging debt to perhaps take advantage of investment opportunities, acquire assets when it's good to do so. And then we just wrapped up with Monique to just start the conversation about this whole thing called a credit score. And she would have introduced us to the two credit rating agencies in Jamaica, bureaus in Jamaica, who would do that. They're pulling information on everybody that comes from various quarters, not all information, but from various quarters, and it gives a sense of how we've been managing our obligations, water bill, any debt payments that we're making to other financial institutions, etc. And it helps. I mean, what would you say, I guess, Monique, is your biggest word of caution to people? Because I don't think this is something that we in Jamaicans are accustomed to. I know in the United States is like them know what color underwear you're wearing and that sort of thing. In Jamaica, we tend to kind of be able to fly under the radar because places are not talking to each other, when it comes to matters of debt. So you can go somewhere, take out a loan and dig off, and then you don't pay that, and then you can go somewhere, they don't know about the last one, and you can leave it hanging there as well. I mean, what's your big word of advice to people when they talk about wanting to make sure that their credit score, their credit rating is as attractive as possible? What's your big word of advice to folks before we move on to the next question?
All right, sure. So maintaining a good credit score or even getting a good credit score would include for you to make your payments on time and in full. So missing a day, missing 2 days, 3 days, those things do have an impact on your credit score. For example, when you have your credit cards, try not to go over the limit. Once you exceed that limit, you may sometimes you have that leverage of the additional maybe $10,000 or $15,000, and you go over your credit card limit. That does have an impact on your score as well. So those are two things. Additionally, even if your financial institution is not directly feeding the information to the bureaus, because as I mentioned earlier, not every institution now is doing that. Please just still make your payments on time. One of the things that will happen is that we will ask you for those statements. And if we pull those statements and we see where you're having missed payments, it will still impact your credit score. Not on the bureau's side, but when it is that we're doing an application for you, especially at JMMB, because we do calculate our own credit score within our application form.
Okay, and that's something interesting to know too. So it's not just when you're applying to at JMMB or any financial institution, I suspect, for that matter, it's not just about the information that the institution is getting from the bureaus, but also anything else they're able to pull. Because as you said, the bureaus aren't gathering everything from everywhere. But the financial institution would be more vigilant in doing so, is what I'm
And
picking up.
just to add, Carrie, if I can, if you have
Sure.
loans that have been sent to collection agencies or have been written off, what some of us tend to do is to say, well, it's at the collection agency, I know my problem anymore. Or it has been written off, are not my problem anymore. It is your problem because it is noted on your credit report as being written off, and it is written off with a balance. So even if you don't have to be making those payments to the institution, it is going to be noted there that this was written off, the balance is still XYZ. So it is still imperative for you to clear that balance and get notification, get something to say, hey, I have closed this out. Because there are times when the financial institutions, we do lapse and the information is not provided in a timely manner, or the information when you close the loan, it is not recorded and it still shows up on your credit report. You need to be able to have something to say, hey, this was closed out. If that happens as well, you can contact the bureaus and they will do a dispute on your behalf. And then that dispute can take those running credits there. So even if it's paid off and it is not showing a monthly payment for you, the mere fact that it is still noted, it will impact your overall total loan amount, and that will impact your score as well.
All right. Thanks for that, Monique. Very sobering words. And I think the overall message again just goes back to how you're managing your budget, how you're managing your personal finances in a way that would ensure that you're not taking out unnecessary debt, and the debt that you are taking out, you're able to manage and to make sure that you are fulfilling your obligations as best as possible. I think I take that point. I want to jump back to Andrew because, yeah, Andrew, I think we've established that if you're not going to be managing your debt, and I think we kind of could come into this conversation having known that already, that if you're not going to be managing your debt properly, then obviously it's going to affect your ability to get access to loans and other forms of financing to do things like get a mortgage, to buy a home, to buy a car, start a business, perhaps, what have you. My question is to you, Andrew, I mean, based on our current context, we know that the BOJ, in its various in its monetary policy activities, have interest rates. We've been seeing interest rates inching up, right? That's definitely in headlines that have been happening for quite a few months now. But we're not going to go into the why of that. But the reality is that as interest rates inch up, we're going to see a resulting impact on everything that those interest rates inform, such as interest rates on loans. What kind of advice or word would you share with folks with respect to what is now pretty much coming into a higher interest rate environment when it comes to the whole matter of advising people about managing their debt and their investments in the context of an environment where we're seeing higher interest rates?
All right. So one of the things that we see a lot, Kerry, from when we're advising clients about their goals and so on, is that higher interest rates tend to excite investors because they tend to think about the returns that they're getting on their investments, but neglect to pay attention to the fact that the cost of debt is going up. And by the cost of debt, we mean your mortgages are going to be more expensive, your car loans are going to be more expensive, your credit cards are going to be more expensive, your unsecured loans are going to be more expensive. So, one of the things, while we want to celebrate, the higher returns on our investments, we have to pay attention to the fact that the debt that we have, the existing debt or the new debt that we're going to take out, is going to cost us more. So one of the things that we really want to pay attention to is the fact that you want to cut down on the unnecessary debt. And by unnecessary debt, we're really referring to the bad debt that Monique spoke about, the debt that is not going to increase your net worth. It's not going to make your life better. A couple of years ago, I think it became very prudent about 3 years ago, where companies were offering loans for Carnival and for ATI and those things. And yeah, it's something that you can access, but is that something that you really want to burden your entire financial situation with? So you want to pay attention to the type of debt that you're taking out. Is it necessary for me to take out this loan? Can I shop around and get it at a lower rate? Is it better for me to take a secured loan as opposed to an unsecured loan? Because unsecured loans typically carry more risk for the financial institutions, and by extension will become more expensive to us. So while they may not need a collateral and it might be easier for us to get, it will be more expensive for us to maintain. So it's important for us to understand that in an increasing interest rate environment, which, as you say, it is coming. It's not something that is not a pie in the sky kind of conversation. It is coming. We really need to look at our existing debts. And you may have taken out a loan 2, 3 years ago. Check with your financial institution to see if the increase in interest rate will affect these existing loans. Some persons may have been locked in at a specific rate, so they won't be impacted. But some of these loans now are variable rate loans, so whereby interest rates go up, the cost on your existing loans will also go. So really want to ensure that you understand the debt that you hold, understand what are the exposures that you have to interest rates, and to really look at it and say, is it something that I really need to have, especially for those loans that you're going to be taking out in the future. Look at it and say, does this really help my financial position? Is it something that I can do without? So that's kind of the line of conversation that we have with our clients on a daily basis.
Boy, Andrew, you see the little outside open up and now you come try flop with show say we can't take out loan figure to the party them. What is the matter with you? But no, it's serious. I'm teasing, right? It's serious. Because it really is a conversation that I know we've been having with some clients and generally I see folks having around that it's so very important for us to look specifically at our current loans. I love that recommendation, guys, that if we have any existing loans with financial institutions of any sort, whether it's a mortgage and a cash secured loan, whatever, unsecured loan, what's the risk of those interest rates changing, etc., and whether or not we'll be impacted based on what's happening now with interest rates inching up and will perhaps continue to inch up, who knows, in the near future. I think it's just an important point that you're raising, Andrew, and it goes back to even what we said earlier about the difference between good debt versus bad debt and what are we taking out a loan for. Andrew, I think you're supposed to be switching instruments or devices for us. So if you want to jump off and we'll continue the conversation with Monique and then you can hop back on.
All right, yeah, man. I'm trying that right as we speak. So I know just
Okay, great. Yeah, man. All right, cool. So yeah, and I think it's an important point because even back to the point earlier, Monique, that we were discussing about the difference between good and bad. I know there have been some discussions about even something like a car loan, right? Because from where we sit, a car, people call it an asset, but really and truly, in and of itself, is a depreciating asset. As I like to tell people, you go down to a new car dealer, you buy a car, when you drive it off that lot, that is 20% of the value, not right off. Well, yeah, maybe not 20%, but it immediately starts decreasing in value once you drive off that lot. But the car loan amount is not going down while it is decreasing in value over time. And so the question then becomes, even if you do need a loan to buy a car, because I don't know who got millions put on to buy a car, I certainly don't. So you do need a loan to buy a car. The question then becomes, how do you minimize how much you're borrowing to how much you're borrowing to buy that car, or certainly the type of car that you're buying and the loan amount you'd have to take, keeping that minimal because of what you're spending the loan on. The car is depreciating in value. I know some people use car loans to buy cars to as income generating tools, such as maybe to run a taxi or an Uber or to rent it out. Those are actually great because what you're doing is you're using the car to generate income in those instances. So how you assess it in those will be different than if you're just buying the car to drive it up and down yourself. But I think it's just a great conversation. Monique, for those folks listening, because I'm sure, we're talking some nice theoretical stuff here, but very factual nonetheless. But I'm sure there's some folks listening who are saying, hey, they're probably a little bit burdened with debt right now, probably got a little bit in too deep. It is what it is. Life happens. This is a judgment-free zone. So let's talk solutions now, Monique, as far as for those persons who are trying to get out of debt. From where you sit as a banking officer, what are some of the options that those folks can explore right now?
All right, so getting out of debt will take a lot out of us because we have to really be disciplined We have to be vigilant and we have to be dedicated to just the process of what we have to do. So some options that I would give to customers is one, make a list of all the debts that you have. And when making that list, include when they will mature. What is my current interest rate? What is my monthly payment? After making that list now, we have to be very, very prudent in making an extra effort to pay off the facilities that have higher interest rates or that have the higher monthly payments. Some persons may want to pay off the ones that are maturing sooner. Whichever method you choose, ensure that it is saving you some money somewhere there. Do not take on any additional debts. So we spoke earlier about good debt servicing, and one of those things that would fall under good debt servicing is maintaining your total debt service ratio. And your total debt service ratio really speaks to a comparison of your gross monthly income to all the liabilities that you have to fulfill at the end of the month. A general rule of thumb is to keep that under 45%. Whilst you may go into an institution and an application is being done and they'll look at that, there are some times where some institutions do not take that rule of thumb into consideration, or you have payday loans accessible to you right at your fingertip. If your debt service ratio is already being bombarded with loans, what that means is that you don't have surplus to service other things that may pop up, and you may be tempted to take on those payday loans or those quick loans, that they don't focus on ensuring that you're doing something prudent for your financial situation. So steer clear of those. When you pay off a loan, do not be tempted to take out another loan.
Stick a pin, Monique, stick a pin. I mean, this is great information. And as I say, I'm learning myself and I want to make sure everybody is following. So the first point you made was about encouraging folks to really make sure that they focus on paying down as much as they can on the higher interest rate loans first, right? Those tend to be usually your credit cards, or if you took certainly maybe for loans from maybe a micro lender who tends to have very high rates sometimes. Those are the ones you're saying you should focus on pulling down as much first. That's what you're saying.
Yeah.
Not to say you're not going to pay off continue your payments on the low interest ones.
So when I said that, what I really meant is any additional payments you're making, you really need to be trying to close those loans first. So yes, guys, we're going to pay back all our loans on time.
But if you have any little brought and you can certainly put down some more payments on a loan, it will be those higher interest rates because you really want to bring down those balances, is what you're saying. Exactly. Then now you moved on to this thing called debt service ratio, and I wasn't good in maths. So when you said 45%, so you're saying that in the example, it's how much liabilities or loans, I guess you could say for the purpose of this conversation, you're carrying, and that total as a percentage of your total monthly income versus gross monthly income. Gross meaning before tax, not gross meaning it's nasty. Right. Although gross, some of us incomes are gross, but I mean, we're talking about gross, which is before tax. And we have to make jokes sometimes. It's a tough topic. It's hard. So okay, great. So debt service ratio, and you're saying in this example 45%. So 45% is where the banks favorably would like you not to go beyond if you're applying for a loan. Right. And that 45% now for the mathematically challenged like myself means that of my total gross monthly income, my loan payments must not exceed 45% of that monthly income.
Exactly. So say, for example, you're working 100,000, just for easy math, $100,000 per month, then all the loans that you're repaying should not go beyond $45,000.
All right. Perfect. Nice round numbers. And then so you started to go into the fact that there are sometimes we may be tempted to take a payday loan to help us bridge the gap, eh?
Yes. So when you do take these payday loans, what happens is that at the end of the month, or whichever month you take it in, once your pay hits your account, they're going to take back that full amount. So if you're already say servicing loans with $45,000, you take out a loan that is another $20,000. Once the balance of your pay hits your account, that $20,000 now will be transferred to clear that payday loan. So you're now left with less funds at the end of the month to carry on with your usual life. And what that does sometimes, it puts us in a cycle of borrowing, repaying every month. So sometimes I'll pull credit reports, and every single month there is a payday loan on the person's credit report, because we find ourselves in these situations from time to time when we're not being prudent,
Okay,
or just
okay. So you're
desperate and grabbing
right.
at straws.
Okay, so your word there is to avoid those loans where unless it's a dire emergency life and death, we really should be avoiding those types of loans because they're only just a band-aid and making a bad situation probably worse, huh?
Exactly. All right. So
Okay,
some other
great.
options would
Yes,
include to
please.
reduce the number of credit cards that you have, or reduce the limit that is accessible to you. Um, there are times when I would pull a credit report and someone's gross income is, for example, $200,000, and then you have a credit card limit of $300,000 or 400 or more. And in my head, I'm like, if my gross monthly income cannot pay off this credit card, why should my limit be so high? In the event that you max that card out for the month, you're not going to have sufficient funds to clear it. And once you don't clear all of your all of the payment for your credit card, that now attracts a lot of interest, etc., and puts us again in that cycle of being in debt. Another option available is consolidation. So that is where you basically combine multiple debts into one singular larger debt. And the aim there is to reduce your monthly payment and make tracking your debt much, much easier.
I like that one, and that's a popular option I find, Monique, because I know there's some folks, again, youthful exuberance perhaps or challenging times. We kind of get in our over our heads with a lot of, especially high interest debts, usually early on in life. And then we want to try and get our house in order. We want to reduce our monthly loan payments to a manageable level. What a lot of folks do is they tend to go to a financial institution like a bank, like a JMB, and they apply for what is called a debt consolidation loan. And then they use the payout from that loan, right? And then pay off the credit card, and all they're left with is that debt consolidation loan, which the interest rate on that loan is far lower than what you would have been paying on the interest rate on the credit card anyway. And a lot of people really found that to be a nice, manageable way to get their debt down. So they still have the debt to service, but the interest rate being much lower, it's easier to digest and pay each month, correct?
Yes, that is correct, Scary.
Yeah, yeah. So it's a very popular option, and it's something that I know a lot of people use to help them to manage their debt situation and help them to dig out of debt where necessary. Thanks so much for that. I love it. I love the fact that you mentioned credit cards, Monique, because again, this is a no judgment zone, and we're keeping it real. Everybody got a credit card. I got a credit card. You got a credit card. We don't have nothing against credit card. Credit cards are necessary. So the question then is, recognizing that your credit card can be your best friend, but it can also be your worst enemy, obviously. What are some of the things, that we need to be mindful of when spending with a credit card? I guess just some nuggets to help us to know what's the wise and unwise way, I guess, to use a credit card.
Well, Carrie, everyone does not have a credit card. I'm really bad at managing credit cards, so I had to pay off mine and get rid of it. I
Oh,
was very
bless
terrible
you.
at doing that. So, not to fall in that trap again. I just do not do with it. All right. So the first thing I will want to highlight here is that having a credit card is not free money. A credit card is ultimately a revolving loan, but if we use it effectively, it can be an interest-free loan. So just some little nuggets here. One, make more than your minimum payment. So a lot of us get trapped in the idea that making the minimum payment is all we need to get by. This is a delusion. The minimum payment made will assist in us
Oops.
not the minimum payment made will assist in us not having to pay any late fees, for example, once it is paid on time. It is important to remember that the interest is being calculated on the balance. So, for example, if we make a minimum payment of $5,000 on a balance of $100,000, the majority of that payment will go to the interest first, and then the balance goes to the principal. So let us say we make that $5,000 payment, and $4,000 goes to the interest. That means $1,000 is going to your principal balance. So at the end of the month and going into the new month, we're going to have that $99,000 balance same way, barely even moved, even though we would have paid $5,000. And this is because, as Kerry mentioned before, the credit card interest rates tend to be much, much higher. Manage your limit. So a rule of thumb, and I shared this earlier, when I'm having discussions with my clients, try not to make your limit more than 50% of your gross monthly salary. And I spoke to, making, for example, $200,000 and then having a limit of $500,000. These are the kind of things that set us up for failure. Treat your credit card like a debit card. And what that means is prepay on the card as much as possible, or spend what you know you can comfortably repay all at once. The latter can result in an interest-free debt if the full payment is made before the due date and you start reusing after your statement date. Emergencies only. So save using your credit card for emergency situations and unavoidable situations. This way, you're not constantly using it and increasing your debt. Shop around with your cards. So shop around for cards that offer you lower interest rates and then the best benefits. So like for reward points, cashbacks, etc.
I'm glad you mentioned those reward points. And maybe, I don't know if Andrew can speak to this. I'm laying hands on him suddenly. But I know that when we talk about credit cards, obviously there is the debt management side of it, in the sense that you want to encourage people when they use credit cards, if they choose to use them, you want people to use them wisely, bearing in mind their limit, bearing in mind their income, how much they can reasonably pay off. And as you rightly highlighted, Monique, this minimum balance pay every month is it ain't a thing, right? Let's just keep it real. You'll be paying it till probably your grandchildren will end up paying it. By kidding, no, but really. But I mean, it's just there with you. It's never going to leave you. The debt will be there for quite some time. But there's also a side to using credit cards that can even see credit cards, as you mentioned, providing rewards and benefits, maybe in the form of some kind of passive income. I mean, Andrew, perhaps based on your experience, how do you see people using credit cards in a way that benefits them? Of course, again, provided they use it wisely from a debt perspective. I'm
All right.
thinking rewards.
Yeah. All right. So I heard you dropping the rewards part of it. So, listening to Monique, and Monique is saying that it should really be used for emergency purposes. I think the landscape has kind of changed as it relates to credit card usage. And not to kind of, I don't want to undercut what Monique has said, but as it relates to rewards, a lot of cards are now offering a lot of rewards for usage. But at the end of the day, one of the things that Monique said is very important for us to pay attention to. Even if you're going to use your card for rewards, you shouldn't use it for more than you can comfortably pay off every month. So while it may not just be for emergency uses, you're going to be using it for things that you can pay off at the end of the month. So if it is that you have your supermarket budget set aside and you're going to use your credit card for the supermarket, then you know that you have that money to repay it. Don't be using the credit card to buy things that are on sale. A lot of times that sale thing kind of catch us where there's something that is 20%, 30% discounted, and we say, no, man, we have to buy it because it's on sale. But we don't really have the money to pay it back at the end of the time. And, those little things add up. Monique spoke about paying that minimum balance. I have seen persons pay minimum balance or portions of the balance, and over time, just interest charges alone bring them above their credit limit. So, it's very important for us to ensure that, yes, there are rewards for using your card, and everybody is giving you rewards, whether it be cashback or travel points or hotel points or whatever it is. Ensure that what you're spending it on, you can comfortably repay it at the end of the month. Monique spoke about ensuring that your credit limit is not more than your monthly salary. It kind of sometimes come with a little bit of prestige when you get a credit card. I remember when I was younger, you got a credit card for X amount, and you can say, yeah, man, my credit card balance, my credit card limit is this. So it kind of gives you a little bit of bravado. But at the end of the day, if you can't pay that off when you spend it, then you're in problems. So it's very important for us to ensure that whatever we are spending on the card, for whatever reason it is, we can comfortably repay it at the end of the month.
I love that point, Andrew, because I know Monique could have started out by saying, because I had said, boy, probably everybody have a credit card, most people have a credit card, and her story, her journey was quite different, and I'm glad she shared that, because there are some people who would have started out on the credit card journey, may have, gotten in again, youthful exuberance, probably got a little in over their head, realized it wasn't for them, came out of it, and have decided not to go back, and that's okay. There's some people who are still on the journey, probably still trying to figure out. There's some of us who have a greater handle on it, and I'm glad you raised the alternate view, Andrew, as well, which is that there's some people who use credit cards with the kind of focus and I guess discipline that says, look, I'm not going to spend more than X amount per month with my credit card. And some people use it to pay certain bills, even because of the passive income component, such as airline miles, cashback, and so on. Just mere fact that you're using your credit card on a day-to-day basis to buy groceries, pay for gas, to put gas in the car, etc. You're getting these rewards components, which is a form of passive income, but you're able to do that within the context of, yes, I'm not going to spend beyond that point. And if you can do that, then that's fine. Some people, unfortunately, for their purposes, that doesn't work for them, and that's okay too. So as you said, I think the point is made is that, there is value to be had in having a credit card, if you believe it's something for you, and how you manage it is important, because the key thing is you really don't want to be in a spiral of a massive amount of high interest debt, and it's just minimum payments you're paying off every month. No, that's really not what we should be striving for. So I think this was a great component to discussion, guys. We have a few minutes left, and I have a couple of questions left that we would have been pulling and putting together as part of our preparation. So still with you, Andrew, and then we'll hop over to Monique in the final wrap up. And again, guys, just to highlight, thanks again for joining. We're recording this session, so if you would have missed anything earlier, or you want to go over something that we've been kind of touching on, then we're going to make the recording available, and certainly you can share it with anyone who would have missed this live discussion but you think could find value. So let's go into the last couple ones. So Andrew, still with you. Obviously in this discussion now, we would have been talking about the whole thing of keeping on top of your debt, managing debt, and of course the whole matter of budgeting is crucial, right? I think that's one of the key takeaways here, is how you're looking at your budget, aka your income and expenditure, and how debt fits into that, and making sure that you're keeping the lines where they ought to be. Again, you are a financial advisor, Andrew. Could you share with us some good financial habits, let's call them that you think persons can adopt to help us to manage debt in a way that keeps us on track to achieve our goals and stays away from the kind of debt that we shouldn't be accumulating?
All right, Kerry. Before I jump to that question, I want to ask you for a minute just to touch on something that Monique said. I didn't want to cut her earlier.
Yeah, man. Go ahead.
As she spoke about, the I think I don't know if she used the word loan sharks, but that is typically how we make reference to them, and it's very easy for persons to get caught in that trap. Reason being because those companies typically ask for less requirements than your average financial institution, and it's a lot easier for you to get a loan there. But typically, 10 out of 10, they're so much more expensive than your more traditional type of lending institution. So I just want to implore everyone who is here tonight, say, stay away from those persons. It may seem like a quick fix, and yeah, you can get this money within a couple of days, and you don't have to carry a job letter, you don't have to carry this, and you don't have to carry that. But at the end of the day, it's going to cost you more in the long run. So I really just wanted to kind of put that out there. As it relates to good financial habits, um, this is something that I learned from day one as a financial advisor, and to this day, this even in my personal finances is something that I practice. Ensure that we have a monthly budget, and not just having it but sticking to it, because when you talk to persons, yeah, they have the budget, but this month I couldn't really do this because this come up and this come up. But at the end of the day, you want to make your budget realistic, and by realistic is you want to look at all the spending that you have to do, ensure that you're accounting for it. And by all the spending, I mean everything. I talk to people a lot about just their fast food spend. Sometimes we neglect to put that in our budget. But when you look at, the weekend spending, you might not feel to cook on a Friday or a Saturday, and you buy some Burger King here and some KFC here. And I hear all my KFC people at work talk about KFC is no for the rich because it is so expensive. But when you spend those $1,000 here, $1,500 there, $2,000 there, it adds up over the course of a month. So it's very important that we ensure that we not only just create it, but we stick to it. And also ensuring that your budget works for you, because you don't want to say to yourself that, hey, I'm going to only spend X amount of money on let's say entertainment, but you're a person who needs to go out or loves to go out every weekend. That amount of money, while it look good on paper, in reality it's not going to work, because you know that your lifestyle cannot stick to that. So just ensure that when you're setting the budget, you make it realistic, you make it work for you. Don't follow or don't try to do what everybody else is doing. A lot of people say, hey, I'm just going to spend X amount on fast food. Maybe you're not a person who cooks at home, and you saying that you're going to spend X amount just to fit in with everybody else, really not realistic. And then you end up taking monies from elsewhere because your budget isn't really realistic. So ensure that you do a budget. It may seem like a very simple task. Sometimes it may seem very or feel very stressful when you look at what is left at the end of the month. But at the end of the day, the budget really helps. From the layman on the side of the road to the biggest Fortune 500 companies, everybody does a budget to ensure that they know what they're earning and what they're spending. So why should we be any different? So just ensure that you're creating a budget on a monthly basis, and ensure that you stick to it, because sticking to it is more important than even making it in the first place.
Yeah, I think that's a great point, Andrew. And I think that it kind of ties to back into looking at your lifestyle. Where are the opportunities where we can see savings and modifications to lifestyle? As much as we may or may not think certain things are possible, as you say, stuff adds up. The weekly treat to the fast food joint to treat the entire family. When you add up those $2,000 every week, that's easily sometimes $20,000 a month just on that fast food treat alone when you add it up. Choosing motor vehicles, the difference between driving a Corolla versus driving an Accord, it's a whole different ballgame when you come to the loan payment that you're paying again for something that depreciates in value very, very quickly. It's tough. It's very, very hard to do sometimes, and it's not easy. But at the end of the day, it's really about making sure that the end goal, which is building wealth, achieving financial accumulation, that is going to put you in the better stead for the long run. And for those of us interested in building generational wealth, all that good stuff, it's worth it. Just one final point, Monique, because I think the debt consolidation topic it's one that always piques people's interest. So we would have spoken earlier about the existence of a debt consolidation loan that exists. Few financial institutions, banks offer it, including JMMB. And the fact that you can take out a loan with a view to paying off any pre-existing loans, especially high interest loans like credit card loans, and then end up just paying back the debt consolidation loan at a much lower and oftentimes more manageable interest payment and monthly payment. Are there any cons to a debt consolidation loan, Monique? Just to be clear, because I know we clearly highlighted the pros. Are there any cons to it or anything persons must be mindful of when seeking to explore if this is an option for them?
Most definitely, Kerry. So one of the most obvious cons to debt consolidation is that the upfront costs associated with the new loan may be high, or it may be something that someone can't afford immediately. And if it can't be wrapped in the loan, then you're now in a difficult spot to get this same loan. You're not always guaranteed a lower interest rate. So some institutions will tailor their, especially if it's an unsecured loan that you're using to consolidate your debts, the interest rates are tailored to your risk rating, your credit scores, etc. So you may not always get that lower interest rate to give a lower monthly payment. The tenor of the loan can also differ. And if the tenor is shorter, then your monthly payment may not necessarily be lower. Consolidation will not keep you out of debt. So what happens with most of us is the moment we think that we have any extra money at all, we are tempted to use it. We're tempted to increase our lifestyle. We're tempted to just do things a little bit differently. So if we are not being prudent and maybe saving that extra funds to use it to pay down our principal, for example, we may end up in the same situation. Again, once persons consolidate and they have some free TDSR space, they're again tempted to go and borrow other loans. So those things are some of the things that are considered to be cons when it comes to debt consolidation.
Thanks so much for that clarification, Monique. And so I think it's important that a conversation with a loan officer is always in order when you're considering if something works for you. And sometimes, yeah, it comes down to some bare bones maths, again, mathematically challenged people like myself. Or even if you're comfortable with numbers or not, a good conversation to really max out the income, the expenditure, what this loan will do to your overall current position on how much debt you're carrying and whether or not it will help is another thing. And as you say, consistent, prudent management of your budget is always a good thing to do to make sure that we get to the end goal. Guys, this has been a great conversation. We're a little bit over time. But again, we thank so much for joining us. It has been recorded, so we're going to make the recording available right after this once we complete the download. So have a listen again. If there's anything you missed, share it with anyone who you think would find it valuable. And the goal is we will be back with you soon. We're shooting for next week, Wednesday, whereas we're still getting our good rhythm with this Twitter Spaces thing, because we normally do Go Get Alive in other channels, usually YouTube, Facebook, but we're trying the Twitter Spaces vibe for a bit to see how that works. And yeah, I think this has been a good discussion. Thank you so much, Monique and Andrew. Appreciate your time and your expertise.
It's always
And
fun talking with you and Kerry.
thanks, guys. So stay safe, everybody. COVID isn't gone. It's still here, but we just still got to stay safe, do what we got to do. Thank you so much, guys. Have a great evening. Take care.